The S&P 500 fell about 2% this week. The NASDAQ 100 dropped 4.6%, and yet the equal weight S&P rose. Small caps gained more than 1%, and healthcare had its best week in years. That split is the whole story for the week ending June 26, 2026. In the next few minutes, I'll show you what sold off, what rallied, why the new Fed matters, and what we did inside the value aligned portfolio. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here's the road for today. First, the scoreboard, then the rotation under the surface, then the Fed, inflation, and oil, then our portfolio, name by name, winners and losers. Stay to the end for the three things that actually matter for your money. Start with the scoreboard. SPY, the S&P 500, lost 2.38% on the week, but holds a 7.4% gain for the year. RSP, the equal weight version, edged up 0.17%. QQQ, the NASDAQ 100, dropped 4.60%. And IWM, small caps, rose 1.43% and now leads the year at 22.3%. Look at the gap between QQQ and IWM in a single week. 6 full percentage points. That one number tells you mega cap tech took the punishment while almost everything else held flat or climbed. This is what a rotation looks like. Money left the heaviest technology names and moved into healthcare, home builders, real estate, and utilities. The index fell because a handful of giant stocks fell. The median stock had a good week. I was talking with a client recently who saw the NASDAQ headline and wanted to sell. We looked at his actual holdings together. Most were up. The headline and his portfolio were telling two different stories. That gap is where bad decisions get made. The sector tape makes it concrete. Healthcare led, up 7.80%, its best week in years. Real estate added 4.05% and utilities 3.88% as oil fell and front end rates eased. Consumer staples rose 2.40%. On the other side, technology fell 5.28%, the worst sector by a wide margin. Communications dropped 2.74% because Alphabet fell over 8% on senior engineers leaving for OpenAI and Anthropic. Consumer discretionary slipped 2.19%. The healthcare move deserves a closer look. Eli Lilly closed near $1,208, up 9.97% on continued GLP-1 demand and momentum into July earnings. Merck rallied 12.99% on positive subcutaneous Keytruda data and a string of analyst upgrades. Novo Nordisk gained 11.30%. Biotech joined in on takeover speculation. After a brutal year for the group, this looked like the start of a catch-up trade in the most defensive corner of the market. Here are the week's biggest movers in the S&P 500. The winners were medical, MedPace up 14.53%, Merck up 12.99%, Moderna up 12.59%, ServiceNow up 9.85% on a strong Jefferies CIO spending survey, and Lilly just under 10%. The losers were almost all chips and storage. Western Digital fell 13.17%, Seagate 12.24%, NXP 11.57%, Broadcom 11.26%, and Monolithic Power 8.69%. The timing is the tell. That sell-off came right after a blowout earnings report from Micron. Revenue of $41.5 billion, up 345%, with management saying chip supply stays tight past 2027. Great numbers, and the group still fell. That is profit-taking on the year's biggest winners, not a change in the business. The biggest force this week came from Washington. The new Fed under Chair Kevin Warsh has moved to a tightening bias. The committee held the funds rate at 3.50 to 3.75%, but the dot plot lifted the year-end median to 3.8%, up from 3.4% in March. 9 of 18 members now expect at least one hike before year-end. Warsh declined to give his own dot. His message was still plain. Inflation has run above target for more than 5 years, and he intends to bring it down. Ed Yardeni at Yardeni Research expects at least one hike this year, with July a live possibility. Inflation is why he can talk that way. May PCE confirmed the problem. Headline inflation rose to 4.1%, the highest since April 2023. Core PCE hit 3.4%, the highest since October 2023. Supercore, which strips out housing and energy, ran 3.9%. Goods inflation was 4.8%. The Fed is holding the funds rate at 3.50 to 3.75%, and the dot plot now points to 3.8% by year end. The bar for cuts is high, the bar for a hike is low. Quick break for the serious investors watching. If you want our free guide on positioning a retirement portfolio for a higher for longer rate world, the link is in the description. No cost, no pitch, just the framework David uses. There is one piece of relief in the inflation picture: oil. The United States and Iran signed an agreement last Friday. Tanker traffic resumed through the Strait of Hormuz and the port blockade was lifted. Brent crude fell from the high 80s to below $77. That should pull headline inflation down quickly. The deeper trend is also soft. JP Morgan ties most of the recent drop in global crude demand to China, where electric vehicle adoption and a weak property market keep eating into oil use. Lower energy helps the Fed at the margin. It does not solve the core inflation problem. And the reason the Fed can lean hawkish is simple. The economy is still strong. Initial jobless claims fell to 215,000. First quarter GDP was revised up to 2.1%. The Atlanta Fed's GDP now estimate for the second quarter sits at 2.5%. The Redbook Retail Index ran up 9.5% from a year ago, and foreign money keeps coming. Net foreign inflows into U.S. equities just hit a record $883.9 billion over the past 12 months. The Sell America story does not match where the cash is going. Under all of this is a debate splitting in two. On one side, the chip suppliers, companies with constrained supply and real pricing power. On the other, the hyperscalers spending enormous sums on that hardware. A cheap new open source AI model out of China this week pushed token prices lower and raised the question Steve Eisman has been asking. How durable is the moat when the application layer keeps getting cheaper? Our portfolio sits on both sides of that line. We expect those two groups to separate more, not less, over the next few quarters. Now our portfolio with full transparency, winners and losers by name. On the leaderboard, MedPace up 14.53%, Merck up 12.99, Novo Nordisk up 11.30, Thermo Fisher up 10.42, and Eli Lilly up 9.97. Healthcare carried us. On the laggard side, NXP down 11.57, Broadcom down 11.26, Nvidia down 8.62, Alphabet down 8.33, and KKR down 7.09. Chips and megacap tech were the drag. That spread is the rotation in miniature. A client asked me last month why we hold both sides. This week is the answer. When one half falls, the other half tends to catch us. The book still gained 1.5% on Friday alone. Next week is short and busy. Monday brings AeroVironment and Concentrix earnings plus month-end pension flows. Tuesday, Nike reports fiscal fourth quarter results into a fresh Evercore downgrade, alongside Chicago PMI and consumer confidence. Wednesday, ISM manufacturing jolts and ADP payrolls. Thursday is the main event, June non-farm payrolls, where RBC expects about 145,000 jobs. A hot number tightens the screws on Warsh in July. Friday, the market is closed for Independence Day. Three things to hold on to. One, the June sell-off was a rotation. Leadership changed hands. The bull market did not end. The S&P is up 7.5% for the year, the equal weight up 10.7, and the Russell 2000 up 22.3. Two, the Warsh Fed has a tightening bias, with core PCE at 3.4% and supercore at 3.9. The bar for cuts is very high. Own businesses that can pass through their own costs. 3. The AI debate is splitting. Chip suppliers against hyperscalers, CapEx receivers against CapEx payers. Here is what we're doing. Nothing reactive. Quarter end is the window to trim names that have outrun their weights and add to underweighted quality where the thesis holds. Thermo Fisher, MedPace, Merck come to mind. And if you want David's team to look at your own portfolio, the link to book a quick call is there too. Watch this one next. where I break down how we decide which winners to trim and which to let run.